My name's Enrique, and here at Empower Brokerage, I get a few questions, quite a few questions about life insurance and how to get life insurance. So today's topic is going to be having to do with, in this case, life insurance and how do they determine the cost of coverage. Well, there's many factors, and this video probably is definitely not going to be covering all the scope of the many factors that go into it. But one of those things, it has to do with our life expectancy. So I'm going to be very general here. So the insurance company, the industry, if you will, has done a study and actuarial tables that have been compiled over time. So the companies have these actuarial studies that pretty much can predict how long a person is going to live. So in today's world, it is predicted that one person will live up to age 121. Believe it or not, my mom, she is now 100 years old, so we're living longer. Medicine is keeping us around longer. So that is why, again, life expectancy has been stretched out to age 121. So the cost of insurance for someone who is very young, say they're a newborn or a 1-year-old, the cost of insurance is very low because, as you can imagine, they are at the beginning of their life versus towards the end. So the risk of someone that young passing away is very low. So in this case, the cost of coverage, depending on the amount, is going to be lower compared to, say, someone who is in their mid-50s. Someone who's in their mid-50s is going to be considerably more expensive than that newborn I just mentioned. So as you can imagine, as we get older, the insurance companies know, as I mentioned, the actuarial tables, they know that more than likely we're going to pass away sooner rather than later. So if we have a brand new applicant, but who happens to be, we'll say 85 years old, or let's say even 90 years old, all things considered, they're healthy, their doctors, have checked them out, mentally they're great, but for insurance purposes, they may not qualify simply because of their age. So the cost of insurance, should they have been able to get it, would have been much more expensive, but the probability is that they're going to be declined because they're uninsurable at that age. Now, really quick, so if that same person who was older purchased a policy that was maybe purchased when they were in their mid-40s, and it was a permanent coverage, not a term policy, so the term policy is going to be more affordable, cheaper, and typically maximum 30 years. So if he bought it when he was in his 40s, it's going to last to his age 70, but no more insurance after that. And if he still qualifies, it's going to be more expensive because he's closer to the end than the beginning of life. So now let's switch. So had he purchased a permanent policy that builds up cash or builds up reserves, or as long as he makes his premium payment, he has coverage. So that permanent policy, as I mentioned, as long as he pays his premium payment, depending on how the policy is structured, he will have coverage for the rest of his life. So even though he's in his 90s, as long as he's paying, he would have that death benefit. There's a possibility, depending again on how the solution was structured, there may be some cash value for him or her to withdraw should there be a need for it. But the whole point is that it costs more money, permanent coverage, because he wants or she wants more coverage beyond the 30 years. Permanent, if that person lives all the way to age 120, 115. As a moment ago I mentioned my mom as an example. Had she had a policy in place when she was younger, she would have that policy today if it was kept up. So the point of all of this, the sooner you start, as far as the insurance, the less expensive. The insurance companies have an idea more or less how long we're going to live. So they base the premium on where we are in our lifespan. Now, I haven't mentioned any of the other factors, such as our body mass index, our medical history, the record living lifestyle, avocations, things like that may impact the cost of insurance. I just thought of, well, what if somebody had the avocation of flying airplanes, not commercial, but they were a pilot? Well, that's a higher risk occupation or avocation, so the insurance company is going to charge them more. Or let's say somebody has a hobby of motorcycle, motocross, or dirt bike racing. That again is a higher risk, as you can imagine, higher probability of somebody seriously being injured or dying from that avocation. So the insurance company is going to charge that person more because there's a higher risk. Now, there's a whole lot more that I can cover, but feel free to call us here at Empower Brokerage at 888-539-1633, or shoot us an email. My email is etorres@empowerbrokerage.com.